Welcome back to The Explainer. So today, we're completely redefining how we look at dividend investing as long-term retail investors. If you've ever felt like those high-yield dividend stocks you picked are somehow actually losing you money overall, or maybe you're just hunting for a more bulletproof way to build lasting wealth, well, you are in exactly the right place. We're going to look way past those superficial numbers and really uncover what genuinely drives long-term success in the market.
Okay, let's dive right into this. Here's our roadmap for today's explainer. We'll start with more than just the score. Move into the yield-chasing trap. Then look at the power of capital gains, how to go about finding cash-generating machines, and we'll wrap it all up with the patient investor mindset.
Section 1. More than just the score.
Right, so it's really time we challenged the conventional definition of dividend investing. Focusing solely on the dividends is like judging a football team only by the goals scored while ignoring the tactics and cohesive team play. Think about it. Judging an investment just by its dividend payout, that is exactly like cheering for a lucky goal in a match while completely ignoring a leaky defense. Did the team win because of brilliant on-pitch chemistry and smart tactics, or did they just get lucky with a loose ball? More importantly, are they going to lose the whole match because their defense is just letting in more goals than they score? You have to look at how the entire team plays. And this brilliantly illustrates that concept. True wealth creation relies on total return. See how the glowing T in that treasure chest is supported by two very distinct pillars? You've got capital gains on the right and dividends on the left. And if you look closely at that magnifying glass, you'll realize those payouts are actually driven by the underlying business quality. Honestly, if the business engine is broken, that dividend key isn't going to unlock a thing.
Which brings us to Section 2, the yield-chasing trap. This leads us to the hidden, and let's be real, sometimes devastating dangers of evaluating a stock strictly by its yield. The absolute most critical question you need to ask yourself as a retail investor is, how is the company actually funding its payout? Are they using genuine earnings and robust free cash flow? Or is management engaging in some desperate financial engineering? Are they liquidating core assets, or even worse, borrowing money just to maintain the illusion of a high yield so they can keep investors happy in the short term?
Now, if a company is relying on those tactics, it is incredibly dangerous. Look, there's inherently nothing wrong with a company returning excess capital to us. But if a business with declining revenue and shrinking profits is using these tricks, that high payout is basically a ticking time bomb. Eventually, the music stops. And that leads to inevitable steep slash in dividends. When that happens, the share price just completely collapses alongside it. Sure, you might collect a few nice dividend checks along the way, but your total return sinks right into the negative. You lose the match.
Now let's flip the coin and look at the other major danger of yield chasing. Greater than 50%. That is the massive share price gain over the past year for the luxury watch retailer, the Hourglass. In their 2025 fiscal year, they cut their final dividend from 6 Singapore cents down to 4 cents, and they maintained it there into 2026. Now, if you were just a pure yield chaser, you probably would have seen that drop, panicked, and sold off your shares. And by doing that, you would have completely missed out on a massive gain of over 50% in their share price.
So, the crucial point is this. The biggest downfall of yield chasing isn't actually just holding on to a bad company and losing money. It's prematurely selling a highly resilient, cash-generating machine simply because of a sudden, short-term payout fluctuation. You absolutely have to evaluate the machinery driving the payout, not just the payout itself. Okay, moving on to Section 3, the power of capital gains.
Let's look at some hard data that proves exactly why capital gains matter just as much as the dividends in your portfolio. Now, what's really interesting about this slide is looking at this 7-year portfolio analysis. The orange bars represent the dividends, right? And the green bars represent capital gains. Notice how stocks like OCBC, UMS, DBS, and Micromechanics generated these massive double and even triple-digit capital growth numbers. Those huge green bars completely overshadow their healthy dividend payouts. In fact, 6 out of the 10 dividend players identified here delivered higher capital returns than they did dividends.
The numbers literally do not lie. Across that entire 7-year portfolio, which achieved a 56% total return, capital gains accounted for nearly 2/3 of the wealth generated. This totally shatters a really common investing myth. Capital gains aren't just for speculative, high-flying growth stocks. They are a massive, foundational element of successful dividend investing too.
To really understand why, we need to compare two different types of dividend assets. If you look back at that portfolio analysis we just talked about, the assets where dividends actually outpaced capital gains were mostly REITs like Parkway Life REIT. Now, REITs are specifically designed to distribute the vast majority of their income. That's great for steady cash flow, for sure, but it leaves them with very little retained earnings to reinvest. On the flip side, quality corporate businesses retain their earnings. They use that cash to fund operations, secure future growth, and basically unlock a completely different gear of wealth creation. This leads to a structurally thicker portfolio value and, you guessed it, massive capital gains.
Let's move to Section 4 and see how this builds into finding cash-generating machines.
So if we aren't just chasing yield, what exactly are we looking for? Well, we need a redefined concept of our entire strategy. Dividend investing is really about investing in established companies with moderate growth and excess cash flow that they simply cannot deploy internally, choosing instead to return it to shareholders. You see, when a great business matures, it hits an inflection point. It doesn't need to burn billions of dollars on aggressive capital expenditures just to survive anymore. It funds its operations, secures its growth, and is left with a pretty enviable problem, a giant mountain of excess cash.
Now, this requires a fundamental mindset shift. You literally have to stop scanning basic stock screeners for the highest percentage yield. It's a trap. Instead, your focus must shift entirely to the business itself rather than the payout. You are evaluating the machinery.
So what exactly does that machinery look like? Well, here are the core traits of a true cash-generating machine. You want wide economic moats, pristine balance sheets, and strong pricing power. But those last two bullet points, absolutely crucial. Management with strict capital discipline. A committed dividend history actually acts as a really healthy constraint. It forces corporate leaders to treat capital as a scarce, incredibly valuable resource. Because they have to pay that dividend, they become highly selective, and they seldom waste cash on overpriced acquisitions or silly vanity projects.
This brings us to our final section. Section 5, the patient investor mindset. Look, identifying these great companies is really only half the battle. The other half is having the right temperament to actually hold them. Let's bring this all the way back to our football analogy from the start of the explainer. When the business team play is elite, the goals and the score will take care of themselves. If you do the hard work to pick a team with an elite corporate engine, strict capital discipline, and cohesive management, you don't need to panic over every single minor dividend announcement. Over the long haul, both your reliable dividends and your capital gains are secured.
I want to leave you with this final provocative question to reflect on as you evaluate your own portfolio today. Are you just chasing the next lucky goal, constantly jumping from one high-yield facade to the next? Or are you focused on the fundamentals, doing the research, and building a true dynasty for total long-term returns? Remember, the real wealth on the stock market is waiting for those who look beyond the yield. Thanks so much for joining me on this explainer, and I'll catch you in the next one.